So I would pick a broad index, but I wouldn't toss a chunk in at any one time. I would do it over a period of time, because the very nature of index funds is that you are saying, I think America's business is going to do well over, or reasonably well over, a long period of time, but I don't know enough to pick the winners, and I don't know enough to pick the winning times. There's nothing wrong with that. I don't know enough to pick the winning times. Occasionally I think I know enough to pick a winner, but not very often. And I certainly can't pick winners by going down through the whole list and saying this is a winner and this isn't, and so on. So the important thing to do, if you have an overall feeling that business is a reasonable place to have your money over a long period of time, is to invest over a long period of time and not make any bet implicitly by putting a big chunk in at a given time.
We've had 14 presidents, 7 Republicans, 7 Democrats. We've had world wars. We had 9/11. We had the Cuban Missile Crisis. We have all kinds of things. The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore, just like you would do if you bought a farm. You just buy the farm and let the tenant farmer run it for you. And I pointed out that if you'd put $10,000 in an index fund that reinvested dividends, and I paused for a moment to let the audience try and guess how much it would amount to, and it would come to $51 million now.
6 high-performing monthly dividend ETFs can significantly enhance your financial stability. If you're interested in ETFs that offer both high growth and regular income, then this video is for you. In today's video, we'll review these 6 ETFs, exploring their growth potential, dividend yields, and overall returns. In this video, I'll reveal which ETF has the potential to turn a modest investment of $10,000 into substantial wealth. So whether you want stable, regular payments to support your lifestyle, or you want to reinvest dividends for long-term growth, this video will provide valuable insights.
Yeah, what should I invest in next? Can I have some tips?
I think actually, if through the rest of his career and beyond, in terms of earning power, then just making monthly investments in a low-cost index fund makes a lot of sense.
If you're looking for a high-yield ETF that pays monthly dividends, the Global X Super Dividend ETF, or SDIV, is a great choice. SDIV focuses on high dividend-yielding equities from around the world, offering a diversified portfolio. This ETF includes companies from various sectors, such as real estate, utilities, and telecommunications, providing a balanced mix of stability and growth. SDIV's strategy is straightforward. It targets the top 100 highest-paying dividend stocks globally. This approach results in an impressive dividend yield, currently around 8%. For investors seeking regular income, this monthly payout can be quite attractive. The fund's top holdings include companies like China Mobile, Annaly Capital Management, and Telefonica. These are well-established firms with a history of paying substantial dividends. SDIV's focus on high yields does come with some risks, as it tends to invest in companies with higher volatility. However, the broad diversification helps mitigate this risk to some extent. In terms of performance, SDIV has shown solid returns. Over the past year, it has delivered a total return of approximately 12%, combining both dividend income and capital appreciation. While this is impressive, it's important to consider the fund's expense ratio, which is 0.58%. This is slightly higher than some other ETFs, but the high yield can justify the cost for many investors. One thing to keep in mind is that SDIV's global exposure means it's affected by international market conditions. Economic shifts in countries where the fund has significant holdings can impact its overall performance. Despite these fluctuations, SDIV has remained a popular choice for income-focused investors. Next, we have Invesco S&P 500 High Dividend Low Volatility ETF, or SPHD, which is designed for investors who seek both high dividends and low volatility. This ETF targets the 50 least volatile high dividend yielding stocks from the S&P 500, providing a balanced approach to income and stability. SPHD's strategy focuses on minimizing risk while maximizing income. The fund's low volatility approach ensures smoother performance during market fluctuations, which is ideal for conservative investors. Currently, SPHD has a dividend yield of about 4.5%, making it an attractive choice for those looking for a steady income. Top holdings in SPHD include companies like Altria Group, Iron Mountain, and ExxonMobil. These companies are known for their strong dividend payouts and stable business models. By investing in these blue-chip stocks, SPHD aims to provide reliable monthly dividends with less exposure to market swings. Performance-wise, SPHD has been solid. Over the past year, it has delivered a total return of around 10%. This includes both the capital appreciation of the stocks and the dividend income. The ETF's expense ratio is 0.30%, which is relatively low, allowing for more of the returns to benefit the investor. One of the key advantages of SPHD is its defensive nature. During market downturns, low volatility stocks tend to perform better, preserving capital while still providing income. This makes SPHD a good option for investors who are cautious about market volatility but still want to earn high dividends. Another important aspect is SPHD's sector allocation. The ETF has significant exposure to utilities, consumer staples, and real estate, sectors known for their stability and consistent cash flows. This strategic allocation helps SPHD maintain its low volatility profile while delivering attractive dividends. SPHD's monthly dividends provide a reliable income stream, which can be especially beneficial for retirees or anyone looking to supplement their income. Whether you're planning to live off your dividends or reinvest them for growth, SPHD offers a solid low-risk option. As we explore these ETFs, keep in mind that, in the end, I'll reveal which ETF has the potential to turn a modest investment of $10,000 into substantial wealth. Stay with me to uncover this promising option. For number 3, I have the Wisdom Tree U.S. High Dividend Fund, or DHS. This ETF is designed for investors who prioritize high dividend yields from U.S. companies. DHS uses a fundamental weighting approach, meaning it allocates more weight to companies with higher dividend yields, which has historically led to superior total returns. DHS focuses on large cap and mid cap companies with solid financials and a strong track record of paying dividends. Currently, DHS has a dividend yield of approximately 3.7%. This makes it an attractive choice for those seeking a reliable income stream from their investments. Top holdings in DHS include well-known names like AT&T, Verizon Communications, and ExxonMobil. These companies are recognized for their consistent dividend payments and stable business operations. By focusing on such robust companies, DHS aims to provide both steady income and potential for capital appreciation. In terms of performance, DHS has delivered competitive returns. Over the past year, the ETF has achieved a total return of around 11%. This return is a combination of dividend income and capital gains from the underlying stocks. The expense ratio for DHS is 0.38%, which is reasonable given the fund's focus on high dividend yields. One of the strengths of DHS is its diversified sector allocation. The fund has significant exposure to sectors like energy, telecommunications, and utilities, which are known for their high dividend payouts and stable cash flows. This diversification helps mitigate sector-specific risks and contributes to the fund's overall stability. DHS's monthly dividends are a key feature, providing a reliable income stream for investors. Whether you're looking to supplement your income or reinvest dividends for long-term growth, DHS offers a compelling option with its focus on high-yielding U.S. companies. Moving on to number 4, I have the Vanguard High Dividend Yield ETF, or VYM. VYM is renowned for its strong performance and low expense ratio, making it a favorite among dividend investors. This ETF targets U.S. companies characterized by high dividend yields, providing a balanced mix of income and growth. VYM's strategy focuses on investing in financially sound companies with a history of paying dividends. This approach results in a current dividend yield of around 3.1%. For investors seeking reliable income along with potential capital appreciation, VYM stands out as a solid choice. The top holdings in VYM include major corporations like Johnson & Johnson, Procter & Gamble, and JP Morgan Chase. These companies are well known for their consistent dividend payments and robust financial health. By investing in these companies, VYM aims to offer both regular income and growth potential. In terms of performance, VYM has shown impressive results. Over the past year, it has delivered a total return of approximately 13%. This includes both the dividend income and the capital appreciation of its holdings. One of the key advantages of VYM is its low expense ratio, which is just 0.06%. This low cost ensures that more of the returns benefit the investor. VYM's sector allocation is another strength. The fund has significant exposure to sectors such as healthcare, consumer staples, and financials. These sectors are known for their stability and consistent cash flows, which help VYM maintain a steady performance even during market fluctuations. The monthly dividends provided by VYM are a key feature, making it an appealing option for those who need regular income. Whether you're planning to use the dividends to cover expenses or reinvest them for compounding growth, VYM offers a reliable and cost-effective solution. Remember, I'm saving the best for last. In the end, I'll show you which ETF has the potential to turn a modest $10,000 investment into substantial wealth. Don't miss out on this key insight. Next up, I have the SPDR Portfolio S&P 500 High Dividend ETF, or SPYD. This ETF is designed for investors seeking high monthly dividends from stocks within the S&P 500 index. SPYD focuses on the top 80 high dividend yielding stocks, providing a robust income stream along with exposure to a broad market index. SPYD's strategy is straightforward. It targets high-yield stocks from a well-known and widely followed index. This results in a current dividend yield of around 4.8%, making it an attractive option for income-focused investors. Top holdings in SPYD include companies like Iron Mountain, AT&T, and Kinder Morgan. These companies are recognized for their substantial dividend payouts and solid business models. By focusing on such high-yield stocks, SPYD aims to deliver consistent income with the added benefit of capital appreciation. Performance-wise, SPYD has been commendable. Over the past year, it has delivered a total return of approximately 9%. This includes both the dividend income and the capital gains from its holdings. The ETF's expense ratio is just 0.07%, which is exceptionally low, allowing investors to retain more of their returns. One of SPYD's strengths is in its diversified sector allocation. The fund has significant exposure to sectors like real estate, utilities, and financials. These sectors are known for their high dividend payouts and stable cash flows, helping SPYD maintain a steady performance even during volatile market conditions. SPYD's monthly dividends are a key feature, providing a reliable income stream for investors. Whether you're planning to use dividends to cover living expenses or reinvest them for future growth, SPYD offers a compelling option with its high yield and low costs. Finally, for number 6, I have the Wisdom Tree U.S. Equity Dividend Growth Fund, or DGRW. This ETF focuses on dividend-paying U.S. companies with strong growth potential. DGRW aims to provide both high dividend growth and solid capital appreciation by investing in quality companies with sustainable business models. DGRW's strategy emphasizes companies with robust earnings growth, high return on equity, and strong profitability. This focus results in a current dividend yield of around 2.3%. While this yield is lower than some other ETFs discussed, the emphasis on quality and growth makes it a strong contender for long-term investors. Top holdings in DGRW include major firms like Microsoft, Johnson & Johnson, and Procter & Gamble. These companies are leaders in their industries and have a history of consistent dividend payments and reliable earnings growth. By targeting such high-quality companies, DGRW aims to deliver both income and growth. Performance-wise, DGRW has been impressive. Over the past year, it has delivered a total return of approximately 17%. This includes both dividend income and capital gains. The expense ratio for DGRW is 0.28%, which is competitive given its focus on high-quality growth stocks. DGRW's sector allocation is diversified, with significant exposure to technology, healthcare, and consumer staples. These sectors are known for their stability and growth potential, helping DGRW maintain a steady performance even during market fluctuations. The monthly dividends provided by DGRW are a key feature, offering a reliable income stream for investors. Whether you're looking to supplement your income or reinvest dividends for compounding growth, DGRW provides a solid option with its focus on quality and growth. Now, to have a comprehensive analysis of how much you would earn if you invested $10,000 in each of these ETFs and reinvested the dividends, I will present the estimated returns based on the historical performance of each ETF. If you invest $10,000 in the Global X Super Dividend ETF, or SDIV, which has an average annual return of 12%, your investment would grow to approximately $31,000 after 10 years. This calculation assumes the annual return is compounded over the decade. For the Invesco S&P 500 High Dividend Low Volatility ETF, or SPHD, with an average annual return of 10%, your $10,000 investment would grow to about $25,000 over the same period. This is based on the consistent reinvestment of dividends and compounding of returns. Investing $10,000 in the Wisdom Tree U.S. High Dividend Fund, or DHS, which averages an annual return of 11%, would result in an investment value of around $28,000 after 10 years. This assumes the dividends are reinvested and the returns are compounded annually. The Vanguard High Dividend Yield ETF, or VYM, has a higher average annual return of 13%. If you invested $10,000 in this ETF, your investment would grow to approximately $33,000 after 10 years. This is based on the reinvestment of dividends and the power of compound growth. For the SPDR Portfolio S&P 500 High Dividend ETF, or SPYD, with an average annual return of 9%, a $10,000 investment would grow to about $23,000 after 10 years. This calculation also assumes that dividends are reinvested and the returns are compounded annually. Lastly, investing $10,000 in the Wisdom Tree U.S. Quality Dividend Growth Fund, or DGRW, which has an average annual return of 15%, would result in an investment value of around $40,000 after 10 years. This is based on the assumption that dividends are reinvested and the returns are compounded annually. Investing in these ETFs can significantly grow your portfolio over time, especially with the power of dividend reinvestment. But which one aligns best with your financial goals? And how can you optimize your investment strategy for maximum returns? If you found this video helpful, give it a thumbs up and subscribe for more insights. Share your thoughts in the comments below, and remember, smart investing starts with informed decisions. See you in the next video.